You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, we're getting into the year end, and we've talked a lot about specific strategies like covered call writing, how to roll covered calls, just some things that we might want to do going into the year end on stocks that we might want to get rid of, stocks that we might not want to get rid of, and just some tax thought that would go into our actual portfolio and our option strategies. So I'm going to continue with that thought, and I'm going to look at, a lot of times we've looked at trades going into earnings, and specifically we've looked at ratio spreads, skip strike butterflies. We've kind of had a lot of those type of strategies, but I noticed today that FedEx was one of the biggest movers in the S&P 500 index today. They announced earnings this morning, and the stock right now is up as of the close. So now I got to point out that right now we're taping Options Playbook Radio on December 20th. The market is closed. It's a Wednesday. FedEx today was up 3.5% approximately, or 8.5 points. That was after earnings, and it closed at 251.07. Now that in itself is a nice little tidbit to let you know about. But what's really big to me is that it's blown away its all-time high. If you go back and you look at the chart in FedEx, you'll see that from basically January of 2015, the weekly chart going all the way up until today is basically looks like a pair of steps. It looks like you could just walk right on up to this all-time high, which was hit today. So the all-time high wasn't the close. It was 253.24, a couple of points higher than where it actually closed at, 251.07. So good news. They also commented about the tax plan that the Republicans just passed, or it's not 100% passed, but it made it through the Congress. And they talked about some of the savings that's going to bring in, and I think that really just boosted the stock. So with all that being said, I think covered call writing is an interesting time to be doing it, and we talked a lot about covered call writing, so let's put a twist to it. I'm going to actually throw two twists in here. First of all, we're going to go out and just say, instead of doing a covered call, implying that you have 100 shares of FedEx in your account, which is no small feat in that it's a $251 stock, so we're talking about $25,000. But FedEx is an S&P 500 index stock. I'm sure a lot of people own it in some way, shape, or form. So with that being said, what about just doing a credit spread around stock that you own. You've had this big run up. It's definitely the last 3 or 4 days. It's just the stock has just taken off. It's quite a bit above its 200-day moving average, and maybe it's just time to bring in a little bit of protection. And then I'm going to actually even add one more twist. Okay, so we own 100 shares of stock. A lot of times people don't think about just doing a credit spread as opposed to a covered call. I'd like to bring in some income, but then again, if FedEx just, we just set an all-time high, maybe it's just going to blow right through this high and just continue on up. So it's an interesting way to position yourself, to give yourself a little bit of protection, but also protect against the upside if the market starts going against you. And I don't think a lot of people think of credit spreads that way. So as always with Options Playbook Radio, this is not meant to be a recommendation whatsoever, but it's an interesting scenario where you might want to think about doing this type of trade, especially in an underlying that has this type of premium, $251. Earnings just got announced, so volatility came in a little bit, but you have so much juice in the underlying just because it's so expensive. So what trade did I look at? Well, when I'm doing a trade like this, when I'm just doing credit spreads in general and it's not around earnings, I like to go out further in time. And I'm not necessarily trying to bring in the whole credit by doing this. I don't want to do a 1-week trade and just hope that it expires worthless and play the hope game. I like to go a little bit further out in time, get some of that juice with the plan that I'm going to close it before we get to expiration. So I went out to the January 8th. The January 26th expiration in 2018. It's 37 days away. Looked at approximately what the expected move would be because I want it to be outside of that range. And the expected move on this underlying for that expiration was about $11. I'm just going to round off. Let's call it $11. Let's call the stock 250. We're looking at 261 approximately. I'm going to go to the next level up. And the call that I'm going to sell on my 100 shares of FedEx, in theory, right, is the 260-250 call. So we're over the expected move out, 260-250, and then if you want to bring in more credit, you could go 5 points wide on your protection and buy the 267.50. In my paper trade for this week, I'm just going to look at doing a 2.5 point wide credit spread on my underlying because I can bring in 45 cents for it. So the midpoint on a 2.5 point wide credit spread is 45 cents. I'd hope to try to get it filled at that price. I mean, the markets are closed right now, so I'm not exactly sure where the markets are at. You're not going to get an appropriate price considering what has happened today in the underlying stock specifically. So we have a 2.5 point wide credit spread that we're going to hopefully bring in about 45 cents on. Now, I'm going to treat this credit spread as a credit spread. In other words, even if I own the underlying stock, after this big run up and everything that has happened, I don't mind being in this trade after earnings and hope that the move was basically overdone. So I'm going to approach it as I'm going to sell this for 45 cents. If the market does go down and I can buy this back for anywhere around 10 or 15 cents, I'm definitely going to do that. And then on the upside, if I'm okay with selling the stock 11 points higher, I can just go ahead and allow that to get called away from me if I would like, or I can put in some risk parameters and say to myself, well, I was trying to make 45 cents to offset some of my risk. Now I'm going to go out and I'm just going to buy it back. If I'm down, let's say 45 cents on it. In other words, it doubles that premium. I might just do it. Okay. So that is one way to approach it. Now, my favorite thing to do on covered calls, and some people call it a covered calls on steroids, is, all right, I am selling a call and I am buying a call as protection. That is a standard credit spread. And if I own the underlying stock and it goes against me, the underlying stock kind of protects against this position. So it's as the market goes up, I'm going to make more on the stock than I would on that I would lose on this vertical spread because I only have a 2.5 point wide spread. So I like that scenario. But some people like to do what's called a front spread to along with owning the stock. So it's a ratio spread that goes with it. And if you got the playbook on your table at home, it's actually page 80. It's called a front spread with calls. So we're going to take the credit spread that we did, and we're going to sell an extra call because we own 100 shares of stock. So in this instance, we're going to sell 2 of the 262.50 calls and buy 1 of the 265 calls, and this is going to go in and enhance our 100 shares of stock that we have in FedEx. So what does this do for me? Well, it is it's allowing me to bring in a much bigger credit on this position, and I still needed to move more than a standard deviation or an expected move, basically, for this underlying to get called away from me. And I still have limited and known upside because of it. I'm not naked that call because I'm long the stock. And so if I sell 2 and bring in 1, as opposed to receiving just 49 cents for this trade, I can now bring in $1.69. And now I'm bringing in some real premium in this scenario. So the midpoint on that trade is $1.69. We'll call it $1.70. But my risk hasn't changed. So my margin requirement isn't any different because the second call that I'm selling is covered by the actual stock that I own. So some people will refer to this as a covered call on steroids. A little bit, in that I can bring in a bunch of premium on it, but I'm going to have this extra call to protect me if the underlying stock just continues on up and blows through my strikes. So I think that these are 2 interesting ways to approach any stock position that you have in your account. Now, if you want to do it so that this trade happens before the new year, well, you can go for it. If you got a lot of premium, you can look at those different expirations. But when I saw FedEx breaking through to an all-time new high, it kind of triggered some of these adjustments to the standard covered call. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like to answer on the program, we can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time and same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finished out. Happy holidays, everyone.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.